Shares of CoreWeave are under pressure today after the AI cloud computing company provided guidance for the full year that fell below analyst consensus. My next guest has the lowest price target on Wall Street and believes that the business is not worth scaling. Let's welcome Gil Luria, head of technology research at DA Davidson. Gil, thanks very much for joining us.
Thanks for having me.
We saw the revenues come in better than expected, but it's the guidance, and that, I guess, has you worried. Talk a little bit about the revenue, though. What did you like or not like about it?
Well, the company's in a mode of ramping up. They're providing compute capacity for Microsoft, and in the future, they'll be providing capacity for OpenAI, and that's what got pushed out. They were supposed to be able to invest 20 to 23 billion of CapEx this year in order to create that capacity. And now they're saying they'll only be able to do 12 to 14 billion, which is obviously considerably less, puts them behind. And they actually had to go to OpenAI to renegotiate their deal so they could continue to get paid by OpenAI, even though they are that late. So that's the disappointing part. CoreWeave's billed itself as the company that can get compute capacity out quickly. So the fact that they had to push out this much of the data center expansion into next year is the disappointment today.
So what went wrong then?
Data centers are hard. CoreWeave is mostly a financial company that is there really to just set up loans to match with chips, to match with customers. And they're stumbling on the fact that building data centers has always been hard, and it's especially hard now since there are so many bottlenecks. It's hard to get the land, it's hard to get the power, it's hard to get electricians to come in and install HVAC. And they have a deal with Core Scientific, which they tried to buy and failed in order to get that capacity out there. And now Core Scientific is not delivering on its promises.
Now, were they too ambitious? Was that the case, or was it something else?
We don't know the details there, but again, these are challenges that a lot of the companies that are building out data centers are facing. It's just most of the other companies, including Nebius, a competitor that reported this morning, are still able to get the capacity out. CoreWeave has needed to push that out into next year based on some combination of those difficulties. A lot of things need to happen for you to be able to turn on a data center and provide that compute capacity to a customer.
So the backlog, I think, is at 55.6 billion. It includes 2.9 gigawatts in contracted power. Are they going to be able to even come close to that? Or are they looking at lawsuits or any kind of challenges like that if this doesn't come through?
So we ask another question, which is, should they roll out that capacity? So far, CoreWeave, that has 30-something data centers, is providing a return on asset of about 4%. Now, it costs them 9% to borrow the capital to invest in order to build data centers. So that is very much like selling $10 bills for $5. It's like borrowing on margin to buy treasuries. So even if they do deploy that capital and get that backlog done, they're destroying value. CoreWeave is the poster child for what's wrong with a great data center build out. You have companies like Microsoft, Amazon, Google, and Meta using cash on hand, they have all the customers, so using all those customers' funds in order to build data centers and get good returns on those. And then you have these incremental players that have to borrow very expensive debt to build something that they don't have any experience doing. So they're destroying value as they do that. So it's less a matter if they can convert the backlog, it's should they.
Now, and is any of it tempered by the fact it had its sixth contract from a prominent hyperscaler, but they're not saying who it was?
So those hyperscalers are taking advantage of the situation. If somebody else is willing to build the data centers for them and give them the capacity, that means they need to deploy less CapEx, less of a drag on their margins, less borrowing that they need to do, so they can have leverage there. They'll continue to buy inexpensive capacity from CoreWeave as long as somebody's willing to lend CoreWeave the money to build those data centers. That's a good deal for the mega caps, for the hyperscalers, not a good deal for CoreWeave or its shareholders.
All right, and you have a sell rating on the stock. The lowest price target is set at $36.
That's right. We think that the debt holders really own all of CoreWeave's assets. Equity holders will get almost nothing by the time it's all said and done.
Will we be able to move it then? Or is there anybody out there interested in it?
Well, once they go bankrupt, Microsoft, Meta will probably buy the assets at pennies on the dollar.
You think that's where it's heading?
Within the next few years, yes.
Wow. Okay. Well, we appreciate you joining us with this, Gil. Thanks very much.
Thank you.
Gil Luria is the head of technology research at D.A. Davidson.